shown on this chart. Skyrocketing corporate profits since the pandemic have been a big driver of the long bull market we've been seeing. These higher profits have come as a result of new technologies like AI innovating productivity, along with relatively open trade. But widespread tariffs and other trade barriers could compress these margins significantly, especially in import-reliant sectors like retail, technology, and manufacturing. We've already seen growth in corporate profit margins taper off over the first 2 quarters of 2025. This leaves the market at a critical crossroads, with 2 potential paths forward. First, the path of escalation. In this Trade War 2.0 scenario, the tariffs are fully implemented, provoking direct retaliation from China against key US exports like agriculture or Boeing aircraft. This could trigger a much deeper correction, with the S&P 500 potentially falling further. Under this scenario, some analysts see tech and consumer indices falling by over 15% and inflation ticking up toward 3.5%. However, other analysts believe a second scenario is more likely: de-escalation. This follows President Trump's established playbook: create shock and awe to gain leverage, then moderate his position during negotiations. We saw this exact pattern back in April. The Liberation Day rhetoric was followed by a pivot that ultimately sparked a summer rally. If this happens again, markets would likely stabilize, with the S&P climbing back as corporate earnings and a potential Fed rate cut return to focus. It already looks like Trump is softening his stance, which has eased some of the panic selling on the market and allowed a partial recovery to begin. This pattern has repeated so many times it has a name on Wall Street: the taco trade, for Trump always chickens out. It refers to buying stocks cheaply after a tariff shock and the belief that the stock could rebound afterwards. Of course, that rebound is never guaranteed. But there's another way of interpreting that acronym: tariffs averse China offshorers. These are companies in places like Taiwan and Mexico that could benefit from businesses shifting their supply chains out of China to avoid tariffs. If tariffs continue to create such volatility and uncertainty, manufacturers in countries that have a more stable trade relationship with the US could see more investment. The market's been hit with a big shock, but history suggests the president's opening move is often a negotiating tactic, not the final word. For investors, the critical task now is to watch for signals. Will we see further escalation from Washington and Beijing, or will the familiar pattern of negotiation and compromise prevail? The answer could set the course for the rest of the year.